Welcome, curious minds. Today we're doing a deep dive into something, well, incredibly important, but often misunderstood. We're talking about the taxation, or quite often the lack of tax on life insurance proceeds. You
Mhm.
might think, it seems simple, but like with anything involving money and the IRS, there are some fascinating twists, some surprising scenarios.
Yeah, right.
So our mission today is really to cut through that complexity, give you some clear insights, and help you grasp the key facts about how these payouts are actually treated.
Indeed. And understanding this, it isn't just for the pros, the financial advisors. It's really vital for anyone doing financial planning, or frankly, anyone who might one day be a beneficiary. We'll start with the basics, the general rule, and then get into some, let's say, specific situations where the tax picture can change quite a bit.
Okay, sounds good. But before we really dive in, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we're discussing, they come from the accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, you should check out the website. They've got extra practice questions, video lectures, detailed support, all to help reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material.
Absolute great resource.
Okay, so let's unpack this. Let's start with the core principle. When a life insurance policy pays out, because the insured person has passed away,
Mm.
what's the first thing a beneficiary needs to know about that money tax-wise?
Well, the fascinating thing here is the general rule, and it's usually good news. Income received by beneficiaries because of the death of the insured. It's generally considered exempt from income tax.
Exempt, so basically not taxable.
Exactly. Simply put, that money isn't taxable income. It's designed as a form of financial protection, to provide support without adding an immediate tax headache.
Wow. So, okay, let's say someone passes and their family gets a payout, maybe $500,000. That whole amount, typically tax-free.
That's the general rule, yes.
Yeah.
And it doesn't matter how the beneficiary is related to the person who died.
Oh, really? So it could be a friend or even a business partner?
Precisely. Could be family, could be any individual, could even be an entity like a trust or a business.
Mm.
The absolute key factor is that the payment is triggered by the death of the insured person. This exemption, it's really fundamental. It's about ensuring financial continuity, helping replace lost support during well, obviously a very difficult time.
Yeah, no kidding. That must be a huge relief. But okay, what if? What if the policy doesn't pay out because of a death? Sometimes, life changes. Someone might decide they need to cancel their policy after paying premiums for years. What happens then? Is that cash tax free too?
Good question. This brings up something really important, often overlooked. When someone cancels or surrenders a life insurance policy before death, they might get back what's called the cash surrender value. Now, here's the catch. If the amount they receive back is more than the total premiums they paid into the policy over time,
Uh-huh.
that excess amount, that difference, is recognized as a taxable gain.
Okay, so it's not the whole amount they get back, just the sort of profit part. Like if I paid in, say, $10,000 over the years and I get $12,000 back when I cancel.
Then that $2,000 difference is the taxable gain.
Yeah.
Exactly.
Right.
The premiums you paid in, that $10,000 in your example, that's considered a return of capital. You're just getting your own investment back, essentially. So that part isn't taxed. It's only the gain, the amount above what you put in, that the IRS considers taxable income. A bit like a capital gain on an investment.
Okay, that makes sense. But what if it goes the other way? What if the cash surrender value is less than what I paid in? Say I paid $10,000, but only get $8,000 back. Do I get to claim that $2,000 loss on my taxes?
No. And this is really interesting and, frankly, a bit frustrating for some. No loss is recognized in that situation. You can't deduct it.
Really? So you can have a taxable gain, but you can't claim a deductible loss?
That's correct. It's an important asymmetry in the tax treatment. You get taxed on the upside, but no tax break on the downside if you surrender the policy for less than you paid. Vital to understand that before canceling.
Wow. Okay, that is a critical detail. Now, here's where it gets, well, maybe even more complex and quite relevant for difficult situations. What if someone is facing a serious illness, terminal or chronic, and they need funds before death? Can they access the policy value then, and how are taxes handled?
Yes, this is where something called accelerated death benefits comes in. It's a provision designed for exactly these kinds of tough circumstances. If someone is certified by a doctor as terminally ill, usually meaning expected to live 24 months or less,
Okay.
they can often cash out the policy early. And here's the key part. Any gain they realize from doing that is generally excluded from taxation. It's tax-free.
That sounds like a really significant help, providing funds when they're most needed without adding a tax worry. What about for someone who is chronically ill, but maybe not terminal? Are there different rules?
Yes, there are specific rules there too. For a chronically ill individual, the exclusion is usually limited. The tax-free amount is typically capped at the amount actually used for qualified long-term care services.
Ah, so things like nursing home costs or maybe home health care?
Exactly.
Oh,
Medical treatments, nursing care, home health aides, that sort of thing. If any part of the accelerated benefit isn't used for these qualified purposes, then that portion could become taxable income.
I see. So the tax break is tied directly to paying for care needs.
Precisely. The intent is very clear. Provide tax-free money for essential care during a time of significant medical need.
That makes sense. Okay, shifting gears a bit. Can you actually sell your life insurance policy to someone else? Is that even a thing? And if you do, what are the tax consequences?
Yes, you absolutely can. It's called transferring the policy for valuable consideration. You're essentially selling it, often to investors in what's called the life settlement market. When this happens, the proceeds you get from selling it are taxable.
The whole amount?
No, not necessarily the whole amount. It's taxable to the extent the proceeds exceed your basis in the policy. Your basis is generally the premiums you've paid in, less any dividends or withdrawals.
Okay, so again, it's the gain that gets taxed. Similar to canceling it, but maybe with different basis calculation.
Similar concept, yes. If you receive more than your adjusted basis when you sell it, that profit is treated as a taxable gain. It's viewed more like selling an asset or an investment in this case.
Right. Are there exceptions, situations where selling it wouldn't be taxable?
There are a few specific exceptions. For example, if the transfer is part of a buy-sell agreement between business partners, maybe to fund the buyout if one partner dies, or if it's part of certain tax-free exchanges, like swapping one insurance policy for another under Section 35, and transferring it as a genuine gift usually isn't a taxable event for the giver in this way.
But generally, selling it for cash to an investor, taxable gain.
Generally, yes. Transferring for value usually triggers tax on the gain. Those exceptions are quite specific.
Okay, good to know. Now, let's go back to the beneficiary scenario. Someone receives that big, tax-free lump sum death benefit. What happens next? What if they take that money and invest it? Or maybe they don't take a lump sum. What if they choose to get the payout in installments over time? Does that change the tax situation?
Great questions, because how you receive and use the money after the initial payout matters. Let's take the first part. If you get the lump sum, tax-free, as we discussed, that initial amount is yours, free and clear of income tax.
But
Now, there's always a but, isn't there? Well, yes. Any earnings you make by investing that money, that's taxable.
Ah, okay.
Oh.
So the original principal stays tax-free, but the interest or dividends or capital gains it generates later are just like any other investment income.
Exactly. The tax-free nature of the life insurance proceeds doesn't shield the future income earned from those proceeds. That's standard investment taxation.
Got it. Now, what about the second part? Choosing installments instead of a lump sum, like an annuity payment stream.
Right. If the beneficiary elects to receive the proceeds over time, in installments, then annuity rules come into play. Each payment they receive is essentially split into two pieces.
Okay.
One part is considered a return of the principal, that's the original tax-free death benefit being paid back bit by bit. And the other part is considered interest earned on the money the insurance company is holding for you.
And I'm guessing the interest part is taxable.
You guessed right. The principal portion remains tax-free, but the interest portion of each payment is taxable income to the beneficiary each year they receive it.
Okay. That calculation sounds like it could be a little tricky. Can you maybe walk us through an example? Let's make it concrete.
Sure. Let's use the example of Robert and Rachel. Robert tragically died in an accident. His wife, Rachel, is the beneficiary of his personal life insurance policy, which had a $500,000 death benefit. Now, instead of taking the $500,000 lump sum, Rachel chose to receive it as an annuity, $25,000 per year for 25 years.
Okay, so $25,000 times 25 years. That's $625,000 total she'll receive, more than the original benefit.
Exactly. That extra $125,000 represents the interest component over time. So how do we figure out the taxable part of each $25,000 payment? You calculate an exclusion ratio, you take the original tax-free death benefit, $500,000, and divide it by the total expected payments, $625,000.
Okay, $500,000 divided by $625,000, that's 0.8 or 80%.
Precisely. So 80% of each $25,000 payment is considered the tax-free return of principal.
80% of $25,000 is $20,000, so that part's tax-free each year.
Correct. The remaining 20%, or $5,000 of each payment, is considered the taxable interest element. So Rachel would include $5,000 in her gross income each year for 25 years.
Got it. That breaks it down clearly. The original benefit amount spread out is tax-free, but the extra earned over time is taxed.
That's the principle.
Okay, that clarifies the annuity rule really well. Now, let's apply some of these rules to a few other payments Rachel received in this scenario. It really shows how different things can be treated. First, Robert's employer paid Rachel $50,000. It was equal to 3 months of his salary, just kind of a standard company practice for deceased employees' widows. Is that $50,000 tax-free, like life insurance?
Good question. And the answer is typically no. Because this payment is essentially tied to his employment, like a form of deferred compensation or a death benefit from the employer, not an insurance policy per se, it's generally considered taxable income to Rachel.
Okay, even though it's paid after his death, it's still linked to his job.
Exactly. It doesn't fall under that specific life insurance death benefit exclusion we talked about earlier. It's more like compensation.
All right, taxable? What about this? Robert also had $15,000 in accrued salary, money he'd earned but hadn't been paid yet. That was paid to Rachel after he died. Taxable, too. Seems like earned income.
You're spot on. That $15,000 is definitely taxable income.
Yeah.
It's salary he earned. Just because it's paid after death to his beneficiary doesn't change its character as taxable compensation.
Okay, so that's 2 taxable items related to his employment. Now, the last one for Rachel's interesting. Robert's employer also provided him with group term life insurance. It paid out $400,000 to Rachel in a lump sum. Now, here's the wrinkle. The employer had included the cost of this insurance, the premiums, in Robert's gross income while he was alive. Does that change things? If he sort of already paid tax related to the premiums, is the $400,000 payout now taxable to Rachel?
This is a fantastic point, and it really tests our understanding. But the answer is generally no, the payout is not taxable to Rachel.
Wow, really? Even though the premiums were included in his income?
Correct. Here's the key distinction. The $400,000 is a payment from a life insurance policy paid due to death. That core principle of the death benefit exclusion still applies. The fact that the premiums might have been taxable income to Robert during his lifetime, often for coverage amounts above $50,000 provided by the employer, is a separate issue. It doesn't taint the tax-free nature of the actual death benefit received by the beneficiary.
That is a really crucial distinction. So the source matters. It's life insurance paid due to death, so it fits the main exclusion rule, regardless of how the premiums were handled for the employee.
Exactly. This whole scenario with Rachel really highlights how you have to look at each type of payment individually. You can't just assume everything received after someone passes is treated the same way.
Absolutely. So summing this up, what does this all mean for you, our listener? We've seen the general rule, life insurance proceeds paid because of death. Usually tax-exempt, big relief. But the details matter hugely, right? Canceling a policy early might mean taxable gains. Accelerated benefits have rules about usage. Selling a policy is often taxable. And even how you receive the death benefit lump sum versus installments changes the tax picture.
Precisely. And if we connect this to the bigger picture, it just highlights how vital it is to, well, understand the fine print, understand your policy, understand how it interacts with tax law. Seemingly small choices take the lump sum or the annuities, this payment from insurance or the employer directly. These can have really significant tax consequences down the road.
Yeah, it's all about being informed, isn't it? Making choices that make sense for your financial situation, especially when dealing with these things after a loss.
It truly is. It's a powerful reminder that not all money that comes your way after someone passes is treated equally by the IRS. Knowing these distinctions can make a real dollars and cents difference.
Definitely. So maybe a final thought for you, our listener, to ponder.
Yeah. Beyond just life insurance payouts and salary, think about other things a beneficiary might receive. Maybe distributions from a retirement account like a 401k or an IRA, or perhaps payments from a trust. How do you think those might be taxed? Applying the principles we talked about today, like return of capital, earned income, specific exclusions, it gets complex quickly, doesn't it?
It really does. And for anyone wanting to explore these topics further, maybe dive deeper into gross income rules, exclusions, inclusions, especially if you're studying for the CPA exam or just working in accounting. Remember to check out farhatlectures.com. They have a ton of resources, practice questions, videos, detailed support to help solidify these concepts. Thank you so much for joining us for this deep dive today.
Pleasure to be here.
Until next time, keep learning and stay well informed.